Hello again. Time to talk about banking this time. Now, one might ask, why am I talking about banking? And the answer is simple. The interests of capital are very important to society as a whole. The reason why is quite simple. In a society based on exchange, the control of capital and loans and other such things involving it are very important. So, how does banking work? And it's also important, on a side note, it's also important for just general living, especially if you want to get a loan. So, how does it work then? Well, for starters, you put your money into the bank. So, let's say you have, I'll just do $1 just for the sake of ease. So, you put it in the bank, and the bank takes it, okay? Once you do that, the bank ties up your investment and others' investments, and they keep a tab on accounts. So, they make sure they know, all right, so this person put in this much, this person put in this much, this person put in this much, and so on. So, what do they do then? Well, they use the money here to give out loans. So, let's say they give out an IOU of $5 so that someone can buy a car or a house. I'm, of course, making the number smaller for the sake of ease, but that is how loans work. It doesn't matter if it's $5 or 50,000 or even 500,000. That is the basic function of a loan. Now, these loans have an interest rate. So, say 5% over 5 years. Interest. And this interest rate must be paid off, and it compounds. So, in this case of the $5, it'll become $5.05 absent intervention, or the person actually paying it off. However, if you do pay at least part of it off, then the actual increase will be lower. At least that's standard compound interest for the situation. It's why, for example, people advise you to pay at minimum the interest on your debt, because if you don't, it'll keep growing. That's why a lot of people with student loans have excuse me there. And that's why people with student loans, a lot of them have issues, is because they don't pay off the interest of the debt, and so it keeps growing and growing and makes it harder to pay it off, because that interest, it doesn't apply to the original amount. It applies to a current amount of debt. And now one might ask, well, if I want to withdraw my money, let's say I try to withdraw, how do I get it back? Because it's loaned out. And in part, they're right. However, there's a little trick banks use for that. It's called a fractional reserve. What this means is when you have money loaned out, the banks will always keep a certain amount in reserve, so if someone wants to withdraw their money, they can. So, for example, the bank might have a 20% fractional reserve. If it has $100 in it, then it keeps $20 on hand in case someone needs to withdraw, while keeping the rest loaned out. In fact, the interest is how the banks make money. So they want to have as much of it loaned out as possible, but they still get to hold some back because, well, someone's got to withdraw it eventually. And that's where the central bank comes in. So in the US, we call ours the Federal Reserve. And so, if there's a giant run on the banks, it can offer loans to the banks saying, alright, they're all withdrawing the money. Here, we'll give you a loan that allows you to give them all their money, but you gotta pay us back later down the line. This is part of the Fed's job of controlling the money. It makes sure that people don't lose all their money on a bank run. Now, it's not entirely necessary if we go by history, because a lot of bank runs were prevented by just having branches in multiple places. Because if you have your branches here, here, and here, all in different settlements with different peoples, then the runs are unlikely to happen at the same time, so you can sort of pull the cash together on the ones currently dealing with the runs, and then shift as needed to maintain just a continual maintenance of this current system. It's also worth noting the fractional reserve percentage usually increases during times where they're worried about a bank run, because of the potential that running out of bank costs. Sorry about this. I'm just yawning. But anyways, those are the basics of it. Now one might ask, why do they do this? It's not a requirement necessarily, but why do they keep a fractional reserve? Why don't they just keep all our money? Well, here's the issue. If they kept all your money, they couldn't make any for themselves, and so how do they pay you your interest? Because it's not like they put it in just an account and just leave it accruing interest. No, they gotta invest it in order to make that interest up. Because when you set up a savings account, normally you set up on your accounts as well interest. So maybe it's like 0.5% or 2%. From savings. So if it's in your savings account, you accrue a small amount of interest on that. Now, it's not as much as if you were investing it. However, it's still a way for the bank to basically pay you for inflation and just holding on to your money. They could not keep this going if they didn't do the IOUs, because if they kept the interest for savings, but didn't give out the IOUs, they would have no extra money to pay people off when they came in to withdraw their money. So, they send out the IOUs, helping people buy houses, cars, and all other things quickly and efficiently. Well, not efficiently, but definitely quickly. And then they use the interest alongside their fractional reserve, both to pay off the interest from savings and to pay themselves. So this is where the bank's profit comes from. It's how banking as a business works. When you have, for example, an IOU that makes pennies on the dollar, it may not look like much, but if you have 100 of them all in different places, all helping people with different things, well, then you can make a lot of money. It's why banks are some of the richest companies now, especially because they're usually the guys investing in other companies. Since after all, if you have someone who needs money from investors, who's the best person to reach out to? The banks. And so that generally just helps overall. Now, it's also worth noting, when it comes to banks as well, they are not just some company. And when I say that, I don't mean that they aren't a company at all, but rather, they're not standard when it comes to importance of companies. Because the banks are the ones who allow people to essentially buy low and sell high efficiently. Because, for example, if you want to buy a house and you wanted to keep saving up to buy a house outright, that's nearly impossible, especially nowadays. But if you have the banks present and they are willing to offer you a mortgage, what you could do is wait for the house to get to a reasonable price that you can afford the mortgage of, and then get a loan from the bank and pay for it that way. And that's where it helps the average people. but also it helps the economy as well. Because if you're a stockbroker as well, that ability is also useful there. Because, for example, you could, hypothetically, get out a loan for the purpose of buying stock, and then using that bought stock, you wait and then sell when it's at a higher price. You can use the profits from this to pay off your interest and pocket the difference for yourself. It's actually part of why recessions can be so bad, because usually what ends up happening is when the interest rate increases, these people who take out loans to do this end up basically holding the bag, well, holding one of the bags, because they're taking out these loans to buy stock and speculate, all under the assumption that the interest is going to stay relatively consistent. Not completely, but enough that they can reasonably be confident in a safe return. So when a recession hits, or the central bank increases the interest rates, honestly, one and the same, really, because the latter causes the former, it results in these people losing out a lot of money. And when the people who are investing in companies are losing money, well, that makes it harder for companies to expand. And so, they shrink, or do their best to preserve what they can during a recession. It's unlikely to work that well, but some have tried it, and it can at least have a chance of success. It's also worth noting, banks function through assuming liability. What this means is, when they give you a loan, they are putting their faith in you to pay it back. You have their money. Technically other people's money, but it's the banks by you giving it to them to manage. And so, when you have them giving you out the money, they're effectively taking on the liability of what you do with it. So if you just default and can't pay back your loans, don't even have something to seize, then the banks, well, they just straight up lose money. It's why you have them with a look at your credit score, because they want to know, is this a person who's actually going to make us money, or are they just going to default? What default means is you can't pay back your money, so what you do have is seized, and the people who are loaning out the money make what little they can from selling your stuff. Meaning, if you're broke and default, they're basically getting back pennies when they loan you out hundreds of dollars, which, as you can imagine, is not very good, especially when the money is needed to, pay off these people, the initial investors, while simultaneously keeping enough of a fractional reserve to ensure that if someone wants to withdraw from their account or take out all their money, well then, they poop out of luck. And so, for the banks, it's really important who they invest in. In fact, when the government encourages banks to be a bit more lenient, it actually can cause a lot of recessions. For example, 2008 is a classic example. In 2008, the government made it easier to get out. I'll back up. 2008 is when the bubble burst. But shortly after the dot-com bubble, the government lowered interest rates to make it easier to take out loans. However, and this is important, this was never going to last for a long time. The inflation it caused meant it was eventually going to have to be increased, the interest rates. And so they effectively lowered the interest rates and encouraged a bunch of people to take out cheap debt, full knowing that it was going to raise eventually and someone would be left holding the bag. They even encouraged variable interest loans that float with the debt market. So if it's a 2% average interest rate, that's what you're interest rate on a variable loan is. If the interest rate goes up to 3% or down to 1%, it's going to follow that trend. Versus a fixed interest loan, which is decided beforehand. Now, the government actually encouraged people taking out low interest, variable interest loans because they wanted them to get houses and, fill the American dream. Would it work? No. Because the result was a boom that could not be sustained. That was what 2008 was. The government said, hey people, take out loans on cheap credit. Oh, would you look at that? The cheap credit's gone because the government increased interest at 2008. What do we observe happen at the very end of that year? Oh, right. The housing market crashes because everyone's defaulting on their loans. So, when it comes to just the whole thing of banking, it's very important to watch out for that. And as a general rule, if you're actually taking out a loan, fixed is a lot better than variable. Because with fixed, it's consistent. The government will always change interest rates. That's how it's currently operating. Unless, say, I get in charge or someone else who does not support the government messing with interest rates, they're going to keep doing so. And since the market's not floating, pick fixed every single time. Without question. Because it's consistent. Now, adding on to this, it's important to note, the banks aren't your enemy. They're just another group of people trying to make money. So, it's not worth looking at the banks as just people who want to scam you. They can be cooperated with, and you can do quite well using them, because they provide a lot of opportunity. For example, debt is generally bad, right? That's what people with common sense say, right? Debt is bad. However, is it? Well, it depends. See, that's why you have a mortgage, which is debt, a car loan, or anything like that. When you have something that's too big to just outright buy, sometimes you have to take out a loan. So, debt can be useful to do that. Now, it's important to pay it off. A better way to say it is ignoring interest is bad. Because interest compounds. It means you lose more money the longer you keep a loan. And so that's bad for you. So unless you want to subsidize the bank for the rest of your life, pay off your debts quickly and efficiently. But for things like opening up a business, which we also take loans for, expanding a business when you can see a clear chance of profitability, buying a house, maybe getting a car, it's a bit less necessary there because you can usually buy it outright for a few thousand if it's used. But when it's profitable or beneficial to take out debt in the long term, feel free to do it. However, watch out for interest, because that's the real killer. It's why we see a lot of people complaining about their college loans, because the interest gets so insane if you ignore it for long enough that eventually you end up with people heavily in debt, like hundreds of thousands in debt for a few of them, and even like 50,000 for many. And it spirals. It's also one of the few debts you can't default on, which means you're going to be paying it even after you lose all your money and all your stuff, which is not good. But this may make no sense, and I'm sorry if it doesn't, but this is a very complicated topic, and I'm not very good at explaining things. Also, if you'll forgive my rather burned arms, I got a bit of sunburn helping some people over the weekend. So, yeah. Also, I'll make another video today. We'll see how it goes when it does come out, but I hope you enjoyed. Goodbye.